Hello and welcome to the channel. Today we're talking about your mortgage. I'm going to show you how to get your mortgage paid off in the next 5 to 7 years with numbers to back it up. But before I jump into that, don't forget to like, share, subscribe to the channel for more business and financial content. And like always, make sure to consult with a financial professional before making any financial decisions. So today I'm going to be going over 2 different strategies that'll help you get your mortgage paid off faster. And the main reason I chose these 2 is because I understand that different people are in different circumstances financially. And I want everything that I share to be something you can hopefully implement in your everyday life. I'll also include timestamps in the description box below, so you'll be able to navigate through the video as needed. So before even thinking about using one of these strategies to pay off your mortgage early, I believe it's important to unpack the mortgage itself so you can have a clear idea of what you're working with. And when I say mortgages, I'm referring to a fixed loan amortized over 30 years. So let's take a deep dive and see exactly what happens every time we make a payment. For our example, we're going to be using a $300,000 loan at a 5% fixed interest rate over 30 years. So what we end up with is a payment of $1,610.46. So that means if we pay that exact amount every single month for 30 years, that $300,000 loan will be completely paid off. So we also want to look at what this loan is going to cost us in interest payments. So if you see here, at the end of 30 years, we would have paid $279,767 just in interest alone. So realistically, just what we paid in interest alone would have been enough to buy a second house. So you can obviously see why so many people are always looking for strategic ways to pay off their loans sooner. Because the sooner you get the loan paid off, the less you'll pay in total interest. So now let's take a look at exactly how you end up paying so much interest. This is what's called an amortization schedule. That's just a calculation of how a mortgage gets paid down over time. At the top, you can see everything broken down into sections. You have the payment number, the date, the payment amount, the interest charge, the principal payment, and then the loan balance. So we already know we're starting off with a $300,000 loan. So let's take a look at exactly what happens when you make your first payment. So you make your payment of $1,610, and the first thing that happens is the interest is deducted from that amount. So as you can see, the interest payment from the first month is $1,250. So literally a little more than 77.5% of your first payment goes strictly towards interest. The reason is because these loans have what's called a front-loaded interest zone. That just means the vast majority of the interest is paid up front during the early stages of the loan. Now, as a consequence of that high interest amount being paid, only $360.46 actually makes it to paying down your principal. And your principal payment is what actually pays down your loan. And as you can see, this payment structure does not change anytime soon. And here's another thing I want to point out. And what we're looking at right here is a 7 to 9 year mark. And by this time, your principal payments have definitely improved, but still the vast majority of your money is still going towards interest payments. And the reason this area is so significant is because this is the area where most people refinance their loan. And here's why. If you look to the far right, you can see your loan has been paid down about $40,000 to $50,000 at this point. And at the same time, there's a very strong chance your home has appreciated, which means you'll have more equity. So here's the challenge with that situation. That money is very tempting and most people go ahead and take it. But what's really happening when you refinance your home is you're getting a new mortgage to pay off the old mortgage. And during that process, you're able to take money out. And when you get that new mortgage, guess what happens? You start back over from year 1 in your amortization schedule. And now, once again, the vast majority of your money is going towards interest payments. And that happens just when you are starting to build up some momentum. Now, if you're just refinancing to lower your interest rate and you plan on maintaining that original payment amount, that's a different story, because that will definitely put you in a better situation. But unfortunately, a lot of times when people refinance, that's not what they do at all. They are definitely looking to pull the equity out of their home. And if they're not pulling money out of their home, they start reducing their payments to the new minimum amount based on the new mortgage. So just to be clear, if you refinance your home to get a lower interest rate and you don't take money out, that's great. But we're going to stay on course with the payments you were previously making to make sure the loan gets paid off on time. Now, going back to the chart, I want you to take a look at month 195. This is a significant month because this is the break-even point between your principal payments and your interest payments. If you look, you're making the same normal monthly payment, and $802 is paying towards your interest, but $807 is going towards your principal. So from that month forward, most of your money will be paid towards the principal. So if you ever wondered how long it really takes for most of your money to start paying towards your principal, you now have your answer. And in this scenario, it's a little over 16 years. But even with that being said, once you make it to month 360, your loan is completely paid off. So now you have a clear understanding of exactly how you end up paying $279,000 just in interest alone. Believe it or not, that's the normal systematic way of paying off your mortgage. Now, how can we get this mortgage paid off faster? Now, let's take a look at our sample family situation. For our example, we're going to use a $6,500 monthly net income, $2,389.54 in monthly expenses, and that mortgage payment of $1,610.46. So that leaves them with a cash flow of $2,500 a month. And that's the amount that's free that they could do whatever they want with. Now, the tool we'll be using in the first example is a line of credit. And this specific line of credit is going to be for $15,000. And there are various forms of line of credit you can use, but for this specific example, we'll be using a home line of credit, also referred to as a HELOC. A HELOC is a line of credit that's secured by the equity in your home. You can typically borrow up to 85% of the value of your home, minus whatever loan amounts that you owe. But unlike a mortgage, the debt in a HELOC is revolving, meaning you could continuously borrow and pay back as often as you like. Whereas with a mortgage, once you make a deposit into a mortgage, there's no withdrawing the money back out. Also, even though you have 85% of your equity available to you, you only pay interest on the amount you've actually borrowed. Now for our line of credit, we're going to use an 8% interest rate. We have a line of $15,000 available, and we have the option for paycheck parking. Paycheck parking is just taking your entire paycheck and depositing it directly into your HELOC. Now let me explain how that can make sense for someone to do. You have to remember that a HELOC doesn't operate the same way that a mortgage does. That debt is revolving, which means when you need to, you'll be able to access your money. So it's almost like turning your HELOC into a bank account. Now here's why that's so significant. With a traditional mortgage, the interest is charged on a monthly basis. But with a HELOC, the interest is charged on a daily basis. So that means when you deposit your paycheck into a HELOC, your balance is lowered the entire time your paycheck sits in that account. So let's say you had a HELOC with a $10,000 loan balance. You make $6,000 a month and your expenses are $4,500 a month. Assuming you get paid on the first of the month, now when that paycheck gets deposited into the HELOC, it lowers the balance for the entire time it sits in that account. So because the line of credit calculates interest on a daily basis, you will only be accruing interest on that $4,000 instead of the $10,000 because your balance is realistically $4,000 at that time. So think of your paycheck as temporarily paying down the balance of your HELOC because that's exactly what it's doing. So you may be thinking, well, how am I going to pay for my normal monthly expenses if my entire paycheck is parked inside this HELOC? So here's the next part of the equation. You're going to be using a credit card to pay for all your monthly expenses. And that's everything from putting gas in your car, paying for groceries, paying for your utilities, along with everything else that needs to be paid for during the month. And the reason you're going to be using a credit card is because that will allow your paycheck to stay parked in the HELOC, which will allow the HELOC balance to be as low as possible, as long as possible. Now for credit cards, they usually give you a grace period anywhere from 21 to 30 days before you owe any interest on the balance. So when it comes time to pay for your credit card, that's when you'll take money out of the HELOC, which ultimately was your original paycheck to begin with. And remember, the monthly expenses in this example was $4,500. So you'll be taking that $4,500 out of your HELOC and paying for the credit card. And what that does is now raise your balance of the HELOC from $4,000 up to $8,500. Now from that day forward, you'll be paying daily interest on that $8,500 until that balance changes. But ironically, guess what happens next? Within the next day or two, you should be getting paid from your job or your other income source, which means there'll be a new deposit of $6,000 going back into your HELOC. And now your balance is lowered from that $8,500 to $2,500. And that's the strategy of paycheck parking to keep the balance of your HELOC down as long as possible. Because the lower the balance, the lower the interest charge. And also leveraging credit cards throughout the month and then paying them off before the interest charge allows you to maintain liquidity. So you can see there's quite a few moving parts to this strategy, but it definitely saves you money on interest. Now let's take a look at this strategy put into effect. If we look at this strategy from left to right, we have the rate, which is the interest rate charge, the payment, which is your paycheck parking, the draw is when you take money out to pay off the credit card, which is paying for your everyday living expenses. Payment to mortgage is a lump sum the HELOC is sending your mortgage to pay it down early. Interest accrued is just the interest you'll be charged that particular month. Interest paid is just the interest you actually paid that particular month. Interest balance is the amount of interest that you owe after you made your monthly payment. Line of credit principal paid is the amount of money that actually paid down your line of credit after the interest charge was deducted. And your line of credit balance, of course, is the amount of money you owe on that line of credit. So as you can see from this chart, every month you'll be depositing $6,500 of your paycheck directly into the line of credit. And then you'll be taking out $4,000 every month to pay for your living expenses. Now, if you go all the way to the right and look at the line of credit balance, you'll see that every few months, that line of credit balance gets completely paid down. And once that line of credit gets paid all the way down, it will then send a new $15,000 payment directly to your mortgage. And this cycle repeats itself over and over, ultimately until the loan gets paid off. Now, here's what it looks like when you actually apply it to the mortgage. Now, on this chart, starting from the left side, we see the payment number, the date the payment was made, the payment amount, the interest charge, the amount that's actually paid to your principal, and then your loan balance. So right out the gate, you can see that $15,000 payment from the HELOC drove your $300,000 loan down to $285,000. Then from that point forward, everything is done as usual. You're making your normal monthly payment of $1,610. The interest charge of $1,187 is deducted, and the remaining goes towards your principal. In this situation is $422. So that looks exactly like the first example of the standard 30-year fixed loan. Now, if you go down to month number 4, you'll notice that you're still making your normal $1,600 payment, but there's an additional $15,000 on top of that that goes in as well. And that additional $15,000 gets applied directly to your principal, driving it down another $15,000. Then you just continue to make your normal monthly payments, and then once that line of credit gets paid down, it will then deposit another $15,000, paying down your principal even more. So how does this strategy affect your overall timeline of the traditional 30-year mortgage? Believe it or not, this strategy will cause your 30-year mortgage to get paid off in 84 months, which is exactly 7 years. But we have to take in consideration that we'll still owe money on the HELOC, and the HELOC doesn't get paid off until month 87. So add an additional 3 months on top of that. So you'll end up with an additional 3 months of paycheck parking, which isn't a big deal, but I believe that's something that shouldn't be overlooked when somebody's thinking about implementing this strategy. So including your mortgage and your line of credit being paid off, the entire timeline is 7 years and 3 months, saving you a total of $222,178 in total interest payments, which is definitely a big deal. And I already know what some of you guys are thinking, because I was thinking the same thing the first time I ran through the numbers of this strategy. And that's, how does this strategy compare to just making additional payments directly to your principal? So that's the second strategy I want to review with you guys today. And I'm going to use the exact same scenario of somebody bringing home $6,500 a month, $4,000 a month in expenses, and $2,500 a month in cash flow. We're going to take that $2,500 a month and add it directly towards the principal. Now, when you look at this chart, you can see that our payment is $4,110 a month. And that's just a combination of the original $1,610 a month payment plus the additional $2,500 a month in cash flow. So you can see the first month interest charge is exactly the same, but our principal payment amount is $2,860. So we're still driving down the principal, but instead of it being lump sums every few months, it's going to be the equivalent amount, but systematically spread out on a monthly basis. Now remember, the interest charge on the mortgage is only 5%, but the interest charge on the HELOC was ran at 8%. And a 3% variance on a loan is pretty significant. So mathematically, it may seem obvious that the 5% loan should be paid off dramatically faster than the 8% loan. But that's not the case, because remember, even though the HELOC has an 8% charge, that charge is on a smaller amount, mainly due to the paycheck parking method. So even though you're paying a higher interest rate, you're paying that higher interest rate on a smaller dollar amount. So the additional principal payment method actually calculates your loan being paid off in 88 months, which is 7 years and 4 months. So the additional premium payments end up paying off the loan 4 months later than the HELOC would have. But if you include the HELOC being paid off as well, it's only a 1 month difference. So literally both examples end up falling in that 7-year payoff range. So since both examples are going to give you about the same end result, here's some things I want you to consider before choosing which one you want to utilize. If you're looking into the HELOC strategy, there's some things you want to be aware of. Typically, HELOCs are given out with a variable interest rate. So because it's variable, that can work for you at times, or it can work against you at times. So just know that the interest rate is not fixed and it can be changed. You'll also have to qualify based on your credit score and show financial ability to repay the loan. And if for some reason the value of your home drops and you lose the equity you had in your home, the lending institution can freeze your HELOC, meaning you can no longer use it as a line of credit. Also, you have to keep in mind that you're literally using your home as the collateral. So if something goes wrong, they can definitely come after your house. Now, if you're thinking about using the extra principal payment strategy, you don't have to worry about the previous risk associated with the HELOC strategy. But there is a huge risk this strategy runs as well, and that's liquidity risk. Liquidity is the ability to turn an asset into cash. When you start dumping all this extra money into a mortgage, there's no reversals. Meaning if an emergency were to come up, there's no accessing that cash. And that's one major benefit that the HELOC strategy has that the extra principal payment strategy doesn't. Because with a HELOC, you can continue to drive the principal payment down, but if it ever came a situation where you needed cash, you can easily get the money back out. So my goal was to give you guys an honest side-by-side comparison on two different strategies that can both get your loans paid off sooner. Because typically videos like this are extremely one-sided and they never mention any of the risks that may be involved. When in actuality, the risk factor is usually the deciding factor if you want to do something or not. So don't forget to subscribe to the channel if you gained any value, and like and share this video so more people can get an honest perspective of these two strategies. And I'll see you guys in this video next.